Good evening, everybody, and welcome to tonight's live stream. Thanks so much for joining me today. My name is David Aaron of Aaron Wealth Management, and welcome to our live stream. We're going to be talking about continuing our conversation on RRSPs in the month of February. This is our fourth video, and this would be on RRSP withdrawals. So we're going to be talking about everything about what happens when you have a RRIF and how do you take money out of your RRIF. So going from RRSP to RRIF. Hope you're doing well. On this channel, we talk about everything investing, life insurance, estate planning, financial planning, personal finance. We answer all those questions. Yes, I'm an active advisor. I actually work with individuals and families, business owners, to help them achieve their financial goals. And I do that through all those subjects. I put videos on that you can learn more. I really believe it's just a core belief that the more education you have around a subject, the better questions you're going to be able to ask. And really, that's the number one thing to solve a problem is just ask better questions. So why don't we get right to it? And I hope you're doing well. If everybody can hear me, you can go ahead and put your comments below. Gurpreet, hi. I guess you can hear me just fine. If you're saying hello, great to see you, Gurpreet, and thanks for joining me on tonight's live stream. We're now going to just jump right into this session. If you have any questions at all, I'll just put let's hear from you. We'll put that up on the screen. If you have any questions at all, whether you're watching this on Facebook, LinkedIn, or YouTube, just put your questions in the chat, and I'll get them and answer them as we go along. Okay, let's go to the first one here. I'll get this illustration up. So what I want you to think about, if you think about what we've been doing in this video series, if you're on my YouTube channel, you can look at the playlist for RRSPs, and this is the fourth video in the RRSPs. So we talked about, like a general overview of RRSPs. How does it work? How do you open one up? How do you contribute to an RRSP? What happens if you take a withdrawal from an RRSP? And now we're at that point where we're talking about RRIF, Registered Retirement Income Fund. And so what I really want you to think about is look at it from a point of view of this. If you could think about the difference between an RRSP and a RRIF, and that is simply an RRSP is really that period of time that you're contributing to your RRSP. And for the rest of this evening, I'm just going to say RRSP because there's too many R's. I'll feel like I'm repeating myself. But so think about, you're making a contribution to your RRSP and you're getting a tax refund when you file your income tax. Now, when you convert your RRSP to a RRIF, this is a Registered Retirement Income Fund. This is now you're doing systematic withdrawals, meaning money is coming out of that account as income to you. This is what you're going to use in retirement to live off of that, along with your other income streams. And you would have that RRIF income added to your personal income tax for that year that you receive the RRIF income stream from. And so there's like a fundamental difference. One, you're making a deposit, and the other, you're doing a withdrawal. So that is really the fundamental differences between RRSP and a RRIF. So I hope that's pretty easy to understand. Now what I'm going to share with you is this graphic, just so we can get a sense of where does the RRIF fit into the timeline of retirement income. So your retirement income, you'll notice that I have on the left-hand side age 54 circled. So I'm pointing out right there that is the last year, well, not the last year, but age 55 is the first year that you're able to actually convert your RRSP to a RRIF. So some people say I can convert it anytime. No, it's from age 55 is when you can convert your RRIF. But most people are going to take their RRIF somewhere between this timeline where it's age 60 to 71. Now, financial planning tells us that we want to use our RRSP for most people at the latest age, which is age 71. But depending on what your financial plan says, you may take it out anytime between age 55 and age 71. In my experience, most people are taking it out from age like 62, 63, if they really need it. And then the rest of the lot are really taking it out at age 71. They're using other assets to supply that income stream to them in retirement. So one thing you need to do before you actually convert your RSP to a RRIF, and that is, I want you to consider consolidating all of your RRSP accounts into one account. And the reason for this is because when you turn age 71, and I'm going to get into the rules around RRIF, at age 71 is where the government makes you take your RSP and convert it to a RRIF. And you can't just RRIF one. At that age, you have to RRIF all of your accounts. So imagine having 5 different financial institutions supplying you a RRIF. You'd have to contact each institution, make sure that they're RRIF'd. You'd have to have 5 different conversations with 5 different institutions about what kind of investments and how much money and everything else. And it's too much work. You want to simplify your life when you're in retirement. So what you really ought to consider is consolidate your RSP accounts into one financial institution and then RRIF at age 71. So you have one payment, one account, and everything is so simplified. So that's one reason why before you actually get to this step, make sure that you go ahead and you consolidate your RSPs. Okay, I hope that's pretty simple. Now let's get into how does a RRIF work. Okay, so a registered retirement income fund must be converted in the year that you turn 71. It doesn't mean that's when you have to receive the income. So again, I mentioned before, you can RRIF your RSP at any age after age 55, but at age 71, the government has mandated that you have to convert your RSP to a RRIF. So at that year, you would simply complete a RRIF application, and then your RSP is replaced by your RRIF. And so those investments are now in your RRIF. Now, it doesn't mean you have to take money out, but let's say if you wanted to defer it a little bit further, then you could defer it up to about a year. So just before your 72nd birthday would be the first income payment that you'd have to do. And so I want to make that clear that you don't have to actually take the money out right away at age 71. You can still defer receiving income from that almost a year later. Now, typically, when you set up your RRIF, you're going to be choosing when you want to receive an income stream. Now, you could choose annually, you could choose monthly, semi-annual. These are up to you. And the financial institution would just simply sell whatever amount of money you need to have, which in this case, if it's set up as a minimum, I'll show you what that means, but they would be paying you into your bank account every single month or year, however you've decided, and that money would just be deposited automatically at each of those intervals into your checking account, and then you do whatever you like with that money. But that's how that RRIF income works. And now, what I mentioned to you just a minute ago, there's a minimum. So what is the minimum, and how does the government calculate how much to give you each month or every year? So let's look at that. This is a formula. I think here, yeah, let's give you this formula right here. This formula, I'll just share it with you, but you don't have to worry about it, okay? Because it's built into every financial institution. They understand how much they're supposed to give you. But if you look at this, it just basically says the value of your RRIF at the beginning of each year, so January 1st, divided by 90 minus your age at the beginning of the year. That number equals the minimum annual payment that you have to take out of your RRIF. Now, you notice I have this bullet point at the bottom of the page. It says, notice age is a key factor in the calculation. So this is, kind of some fancy math, and I don't want you to have to worry that you don't have to figure that out. All you have to decide is how much money. Do you want the minimum, or do you want something above the minimum? And I'll get into what happens if it's a minimum. But let's look at this as an actual example. Here are the tables that the government says, given your age, this is a percentage of the total RRIF that you have. So if, let's say, you had $100,000 and you're 65, you'll see that in the middle column. You have to take 4% of your RRIF out that year. That's the minimum amount that you must receive that year at age 65, if that's when you chose to take your RRIF. So you can see each year that goes by, the percentage increases. Now in 2015, actually, it was quite higher than this, and they changed that because a lot of seniors were saying, look, I don't need so much money. Do you think you could just simply change this so that we don't have to take out 7% of our money at age 65? So they actually did that. They reduced that RRIF minimum down 25%. So at age 65, it's only 4%. So that's the minimum that has to come out of your account. And by the way, I'm just checking again to see if there's any questions. Remember, if you do have questions, just go ahead and put those into the chat box, and I'll be sure to answer as we go along. So that RRIF minimum, that's really what you have to take out every year. Now, I kind of said something to you a moment ago, and that was either a minimum or another number. I've said in other videos as well, what is the maximum RRIF that you can take out? Well, all of your money if you wanted to. But the key here is that you have to take whatever money that you received from your RRIF, you have to include that in your personal income tax for the year that it was received. So if you took all of your money in 1 year from your RRIF and you had a sizable amount of money in there, that would be a tremendous burden in terms of taxes that you would have to pay to Revenue Canada. So that's not I mean, you would really have to think that there's a better rate of return for you out there than 53%, because that's probably what you're going to lose if it's that much money coming out of your RRIF at one time. Okay, here is the types of investments. I'm going to go into a couple other details as we move along, but I just wanted to sort of people ask me all the time, what can I invest in my RRIF? Well, pretty much almost what you can invest in your RRSP, you can invest in a RRIF. Stocks, bonds, GICs, mutual funds, segregated funds, ETFs, that's exchange traded funds. Now, again, the RRIF is a tax-deferred account, just like your RRSP. So you don't pay any income tax on the growth of your investments. So as your money is invested in your RRIF and it's earning growth, right? You're earning a rate of return. You don't pay tax on the money that you make in the RRIF. You only pay tax on the money that you take out of the RRIF. And that's so important for you to see that point, because a lot of people think, well, if I make money in my RRIF, I have to pay tax. No, this is a tax deferred account. Okay, some other points for you to consider. Now, I want to go back to this table because this is kind of important for people to see how to pay less or how to receive less income from your RRIF, meaning pay less tax. So think of it this way. You're now at a point in your life where we looked at this retirement income timeline, and it says basically you're receiving income at these timelines in retirement. So your RSP becomes a RRIF, you have a tax-free savings account, you might have a pension plan, you could have some non-registered account, maybe a downsize, you've got a large amount of non-registered money sitting there. So you're taking money from a lot of different places, and some of that is being taxed to you and some of it is not. But if you have a lot of income stream coming in, so for instance, what if you had rental property and you had a pension plan and your taxable income is actually quite high right away? Well, now all of a sudden now at age 71, you have to include your RRIF income on top of that. So the government allows you to actually put the age. Remember I said age is a key point here. Age is a factor in how you calculate the RRIF. So look at this table again. So if we went to age 65 and looked at age 66, or in some cases where I've seen people who are maybe 10 years apart in ages, you're 65 and your spouse is 75. So let's look at the 75 age. You see that the RRIF factor is 5.82%. So let's say you're the 75-year-old and your spouse is 65 years old. Well, you could set up your RRIFs and RRIF using your spouse's age if they're younger than you. So instead of drawing 5.82% out, you're only drawing 4% out. So this is useful if you really don't need your RRIF income and you're trying to minimize the amount of income coming in because it's fully taxable in your hands. So use the spouse who has a younger age. Now, the same is true though if you really need the income and you're going to use your own age, then obviously. But then one of the things about RRIF income, and I want to go into sort of taxation around RRIF income, and that is how you're taxed on the income. So when you have a minimum RRIF payment, You have no withholding tax. Remember in the other videos we talked about withholding tax on RSP withdrawals? Well, the same would be true with RRIF income if you draw anything out above the minimum that the government is prescribing. So they're at age 65, the government says you can have 4% of your money. Anything above that, we're going to charge the withholding tax the same as it would have been in an RSP as a withdrawal. So this is really key, so that you sort of plan well in advance using your financial plan and your financial advisor to actually map out so that you're not having to withdraw more than your RRIF, and you have other assets to draw on, hopefully that are non-taxable, so you don't increase your tax base. This is really important. So you don't have withholding taxes. If I hope that is clear for you, and if it is, great, you can give me a thumbs up. And by the way, we're not done. We're almost done, but don't forget to like and follow and share this with anybody that you think needs to see this. Okay, moving right along, we're going to look at something that some people aren't aware of, and that is spousal RRIFs. So we looked before about RSP, spousal RRSP accounts. Well, let's look at the natural progression of this spousal RRIF account. If you're contributing to your spouse's spousal RRIF account, or you contributed to your spouse's RSP and now they RRIF, if they take out the minimum amount each year, then especially this 3-year attribution rule, then there's no withholding tax. But when they go to RRIF their account and they take out more than the minimum, then the person who contributed to the spousal account is going to have to pay the tax. And so what's the problem with that? The problem is the person who contributed to the spousal plan probably was in a higher tax bracket. And that's not a good thing, because now you're going to, that tax is being attributed back to the higher tax earner, and you don't want that. So just be careful of that when it comes time. When you're getting close to retirement, map out how much money you're going to be wanting to take out of your retirement accounts. And if you think that you're going to be taking out more than the minimum amount, then you need to be aware that you have a 3-year attribution rule on that, okay? Now, some people have asked me, can I have multiple RRIF accounts? And the answer is yes, you can. Same is true as you can have more than one RSP account, you can have more than one RRIF account. But the one thing here is that when you turn 71, all RRIF accounts have to start paying an income stream. You can't just RRIF one and not another. Now, there is a situation where if you had prior to age 71, one of the strategies that we talked about in one of the videos before, and that is that you may want to think about if you needed money. So let's say you retired at age 65 and you didn't have quite the amount of money you needed for your living expenses, and you needed some of your money from your RSP. So one of the things you could do was you could split your RSPs into 2 RSP accounts and only RRIF enough money. So turn one RSP into 2 RSPs and only RRIF the amount of money that you need to supplement what is the shortfall in what you already have an income stream. So that way you leave the other RSP alone and you let it stay invested, tax deferred all the way to age 71, and only just RRIF the amount that you really need. Again, this really is about financial planning, the relationship you have with your advisor, looking at your financial plans, looking at which accounts you're going to be withdrawing from first, running different scenarios to make sure which ones do I take first. Do I take my non-registered account? Do I take my tax-free savings account? Should I RRIF early? What about CPP and old age security? Should I take them later? Should I take them sooner? Your financial plan is going to help you to spell out exactly which account you're going to withdraw from first, to not just maximize your income, but also to minimize your taxes as well. So this is super important. Moving on, check to see if we have any questions there. I think we're okay. Now, about the RRIF income, when we went back to taxation, and we're almost done, a couple slides left. Now, an RSP, when we talked about doing a withdrawal of an RSP, when you do that, there's a withholding tax. And you can't income split in an RSP, but you can income split in RRIF income. So this is really important because it's kind of like pension income, isn't it? So for RRIF, when you go to RRIF your RRSP account, that's now eligible to use income splitting with your spouse. So it lowers your overall tax rate. Now, the last slide I have for you today is what happens with your RRIF when you pass away. So the real key here is that you're receiving an income every year, and you have, let's say you've got $1 million in your RRIF account and you're taking out money each year. It's coming in monthly, and the person passes away. Now, a large portion of that money in your RRIF was money that you didn't pay tax on. And so what happens is the full balance of that RRIF becomes payable in the day that you pass away. So that $1 million all of a sudden gets added to your personal income tax that year. That is like obviously a lot of income tax you're going to have to pay. And so one of the things that you have to keep in mind when you have a RRIF income, and if you don't have a spouse, that is, that all of that money is subject to tax, and you're going to lose well over 40% of it if it's sitting in your RRIF account. So one, spend it, use the money, contribute to, if you don't need the money, contribute to a life insurance policy so that you have something to offset the taxes that would be on your estate, because with large RRIF accounts, not having any life insurance to offset that tax is a severe amount. I mean, really, who do you want to pay? Do you want to pay Revenue Canada, or do you want to pay your beneficiaries, your children's and your charities? So think about tax planning. Think about estate planning for your account, especially with RSPs and RRIFs, that a lot of people are pushing those to later years. And we live on average about 28 years in retirement. Average death in Canada is around 86. And so a lot of people are dying with balances in their RRIF accounts. Now, if you're married, your RRIF rolls over to your spouse on a tax-free basis. There's no disposition from a tax point of view. That money just now becomes your spouse. And then on the last death, so when that spouse passes away, that's when all that money goes fully taxable. So the process of what happens is your RRIF account is deregistered. It's sold for cash. The cash is now sitting in your estate. And I'm going to kind of split it off into another side note, but the money is just sitting in your estate. Basically, it's in a trust account at the bank, and your executor has to now send checks to Revenue Canada to pay the tax on that. And so there's a bit of a delay, right? And you have to pay the tax to CRA. The executor gets up to 5% of that money if they wanted it, and some delays because that money has to be probated. 1.5% of that money has to go to the government because it's sitting in your estate. So you're looking at 3 months to 6 months to just go ahead and wrap all that up and send it to your beneficiaries. Now, if you were to use segregated funds, and you know that I'm a big proponent of segregated funds when you get into this age bracket, segregated funds allows you to bypass your estate, so there's no probate, so you don't have to worry about the 1.5%. Because it's not in your estate, your executor doesn't have to disperse those funds to your beneficiaries, so you don't lose the 5%. So right away, you're not losing 6.5% of your RRIF money. 100% of your RRIF balance at the day of your passing goes to your beneficiaries. So whomever you've named as a beneficiary, the checks are cut as per your direction, 50%, 30%, whatever that is. Those checks are cut. 100% of that money goes to your beneficiaries. Then your estate has to figure out how to pay the taxes on that amount of money. And I don't want to go into great detail. It's just the differences of what kind of product you're using to invest in. One causes like a mutual fund or just having money in the bank. That has to go through probate. Whereas if you've got your money in segregated funds, it totally bypasses that process and money goes right away. So there's no delay. You don't have to wait 3 to 6 months for your will to be probated. Your beneficiaries are going to get that money within about 10 days of your passing. And so it's convenient, no delays. You don't pay probate, don't pay executor fees. And the next thing that I love, and this is the one key for my clients that they like, and that is privacy. Because the money is not part of your estate. If it was part of your estate, It makes up your will, and a will is a public document. Anybody can look it up and see how much money you had and where it went. Whereas in a segregated fund, that money is private because it doesn't go into your estate and it goes directly to whom you've named as a beneficiary. So I hope that's helpful to you in understanding how that works. Okay, I'll just check to see if we have any questions because I am done. Can you believe that, Gurpreet? Can you believe that I got it done in such a short time? I have a question here. Do I have a video? I'll put it on the screen. Do you have a video on how to convert your RRSP to segregated fund in RRIF? Thanks. I think I do. Actually, there's 53 videos there, and I'll just send you, Rosemary, I'll send you an email as to which one. But what you're really talking about is just converting from an RSP to a RRIF. It's administrative. There's no, it's not something that you really need to do. When it comes time, if you have a relationship with an advisor versus a bank's going to notify you and say, you've got to convert your RSP to a RRIF. And all it is paperwork. You're just signing that you're now opening a RRIF account. And now you want to put your money that you had in RSPs into your RRIF. So it's really seamless. It's actually very simple to do. And things just keep going. You keep investing. It's not, there's no real complicated mechanism. As it relates to segregated funds, though, segregated funds is just a product. A segregated fund is basically a mutual fund that is offered by an insurance company, but the difference is it has guarantees that a mutual fund doesn't have. And so I think is more useful for people who are 50 and above, because you're thinking about, how do I protect my assets? How do I make sure that my money is going to not be subject to the delays in estate and probate and executor fees? And I don't want anybody arguing about my money after I'm gone. I just want the money to go to whom I want. So it simplifies the estate planning discussion because the money just goes right over to whom you want. So there's not really, it's not really something that you have to try to figure out how to do. It's just simply selecting segregated funds as opposed to investing in a GIC or a mutual fund. It's just a product. And you, inside of a segregated fund, has the same things that you might have in a mutual fund. So the same underlying security. So there's no real difference. It's just the product is different. But good question, Rosemary. Okay, I'm going to also, as I always do in every single video, and stress the idea of having a financial plan and seeing the outcome of your planning decisions before you commit to them. Now, this, I have to tell you, having a financial plan from the very beginning, I stress that, but this is really important. This is a part of your life where you're now switching. Anytime you have a major financial change in your life, well, you're switching. You're going from RSPs to RRIFs. And it's not so much at age 71. It could be whenever you're ready to receive an income. You're now changing everything. You said, I'm going to retire. I'm going to receive an income. You need a financial plan to calculate, to make sure that you're optimizing your income streams and making sure that you're paying the least amount of tax as you move through life. It's so important because that tax is just drawing away from your ability to fund your retirement. So that's why it's so important. Again, guys, I want to thank you for joining me today on today's video on RRIF withdrawals. It was actually a short video because it's not a complicated subject. It's actually very simple. And I look forward to seeing you next Wednesday. If you have any video suggestions that you'd like for me to make, please let me know and I'll be happy to put those videos together. I always say in each video, we take care of your wealth management so you can take care of what's most important, and that is your family, obviously. Here's my contact information. If you have any questions at all, feel welcome to reach out to me on any of my social media accounts or via email, and I'm happy to talk to you anytime. And again, looking forward to seeing you next Wednesday at 7 o'clock. And I hope you're enjoying the content on my YouTube channel. Thanks again for tuning in, and we'll see you again soon. Take care. Bye-bye.